Okay, so this is the balance sheet lecture. This part we're going to talk about just the asset side of the balance sheet. Okay, hopefully you remember from Accounting 101 or Accounting 110 from financial accounting that the balance sheet is one of the financial statements that we really need to concentrate on. That along with balance sheet, income statement, and statement of cash flows. Today we're going to focus on just the balance sheet, and specifically on the balance sheet we're going to focus on the assets side. So if you remember that the balance sheet has assets equals liabilities plus owner's equity. Sometimes you'll also see owner's equity referred to as shareholders equity, or SE. Okay, really all this is on the asset side, on the asset side, a listing of what you have. I'm going to cross that out quick. Asset side, it's a listing of what you have. Okay, so if you think of yourself as a person, you will have a list of assets. So if you ever apply for a loan or so, the banker is probably going to ask you, hey, can you list off, if you own any property, if you have any bank accounts, if you have a checking account, if you have a brokerage account, do you own a car, do you own your own house? So they'll ask you what you have. That they're trying to get a sense of what your assets are. Okay, so while on the balance sheet, one side is a listing of everything that you have, that's the asset side. This side of the balance sheet, the liabilities plus owner's equity side, is really a listing of how you came to have the stuff you have. Okay, and it balances out nicely. So it's the balance sheet. So what you have on the asset side has to somehow be explained by how you got it. And in this world, we classify how you got it in two ways. You either borrowed for it or you bought it outright. You kind of own it. Okay, so everything that you have, it's either somebody else's property, technically, kind of, sort of, right? Or it is your very own property. So let me take the example of like a car. If I list my car as an asset, I might have came to have my car by taking out a car loan, right? In which case there would be some debt associated with my car. And then let's say I worked my job in high school and I worked really hard and I saved up money and I took those earnings and purchased a car. So on the asset side, I have a car and it's balanced out with how I got that car. I took out a loan and I used my own earnings. So that's kind of the mechanics, overall, big picture, how the balance sheet works. Today, we're going to focus on how to read the asset side. Specifically, how do you read the listing of of what we have? Because there's this very specific way in which we write that list out of what we have for a company. Okay, so to back up the conversation a little bit, let's focus again on what the balance sheet actually tells us. The balance sheet tells us what we have, what the company has, at a single point in time, at one point in time. Okay? In this sense, it takes stock of what an operation has, owns, or owes at any period of time. So on the asset side, don't confuse this stock with like shareholders equity or shares of stock that you might buy on a stock exchange. This is kind of like when you take stock of your life, when you take an evaluation of your life. So the balance sheet shows at one point in time what you have. Okay? And since it is one point in time, just like one singular point in time, we call the balance sheet taking stock of something. We take stock of what we have inside the company. Okay? Versus, you're going to hear this term also, a flow. So balance sheet tells you what you have at a point in time versus a flow of telling you what happened during a period of time. Okay, so just by looking at one balance sheet, you can't say what happened during the year. You can only say how the company ended that year and what that company has at the end of that year. You won't know just from a single balance sheet what happened during the year, the flow of items, the flow of funds during that year. So that's the difference when you hear people talking about stock versus flow. Okay, so balance sheet. Again, we're going to emphasize that there are assets, liabilities, and owner's equity. The liabilities and the owner's equity lectures will come later on. Okay, so on the asset side, An asset really is anything of economic value, okay, that the organization has, that the company has, or as you as a person have. So if I'm talking about my own balance sheet, it's anything that I might have of value. So my house has some form of value, it would be an asset. My car has value, so it would be some form of asset. My bank accounts are cash, and so it's got value, so it's an asset as well. Okay, so just anything and everything that has value can be considered an asset. Okay, so again, assets are what you have. Okay, there are really two ways in which you can categorize and start thinking about your assets, and two ways in which professionals are really categorizing assets on the balance sheet. So not you can think of, but that you can categorize assets. Okay, the first way in which you can categorize assets, right, is by liquidity. How liquid are those assets? And by liquid, I mean how quickly can you turn those assets into cash? So cash is already cash, so we consider cash to be the most liquid of assets because, you know, I can't universally trade my car as value, right? But cash is cash is cash is cash. I can take cash anywhere and really trade it in for something else. Okay, so cash is the most liquid. It flows most easily. The less liquid something becomes, right, that just implies that it's harder and harder to turn it into cash. So on one end, cash is the most liquid, and then, so like cash on hand is the most liquid. Cash in a bank is slightly less liquid than cash in hand, right? Because in order to turn it into something that's truly of value, I have to go to the bank, grab the cash from the bank, and then like go ahead and spend it, right? So that's slightly one step removed, and then, you know, down the chain. So something even less liquid like than cash would be if I have stocks or mutual funds, right? I can liquidate those very easily, right? But it's a little bit more hassle than having cash. Now going way down on the list of liquidity, right, would be property, plants, and equipment. So something like my car. So although my car has value, it's an asset, it takes me a little bit longer to turn that car into cash. So I can take my car, I can list it on Craigslist, and then I meet with a bunch of creepy people on Craigslist who want to buy my car, and then after like a week or so, I might be able to sell my car, right? It's taken a lot longer than pulling cash out of my pocket or going to the bank and withdrawing cash, or it's taking a little bit longer than going to my brokerage account and selling a couple shares of stock and turning that into cash. So there are varying grades of liquidity. Okay, so when we list our assets down on a balance sheet, we list them in terms of liquidity. On the top of that list are the most liquid assets. Okay, and then going down equals decreased liquidity. Okay, so as we go down the list of assets on a balance sheet, we start off on the top with the most liquid assets, and then towards the bottom we get to the least liquid assets. So usually on the bottom what you end up finding is property and intangible assets, which we're going to get to in just a bit. Okay, you're going to hear two terms when people refer to the liquidity of assets. They're going to refer to current assets, and then they're going to probably have a section for long-term assets. So anything that's really not current is considered long-term. Okay, and the company will break out what a current asset is. Current, whenever you see current in this world, it just means within the next 12 months. Okay, within the next 12 months. So always remember current as in current period, and companies live for a very long time, and so 1 year or 12 months is a very short period of time for them. Current assets, it's really anything that can be liquidated within the next 12 months. It either can be liquidated in the next 12 months or it will be liquidated in the next 12 months. Okay, so if it's not current, then it's a long-term asset. So if it's not liquidatable within the next 12 months, then it's a long-term asset. Okay, so that's what we mean by liquidity, and that's popularly the way that assets are listed on the balance sheet, from most liquid to the least liquid on the bottom. Okay. The second way in which we can categorize assets on the balance sheet is by tangibility. tangibility. Okay, so I forgot if this is a Greek or a Roman or Latin root, but tang, right about over there, is whether it's touchable, right? Whether you can feel this asset or not. So cold hard cash, I can feel cold hard cash. If I have a car, I can touch my car, right? If I have a building, the building is something touchable. If I own furniture, that's tangible. All of those are tangible assets. For the most part, the assets that you see on a balance sheet for hospitality organizations are going to be tangible assets. There are another class of assets called intangible assets. So in meaning not. So not tangible assets. Assets that you cannot physically touch. And generally what you find here, especially for hospitality organizations, is you will see goodwill on the books. Okay? A goodwill as an asset. And then you might have other classes of other intangible assets. You might just see a bucket account say other tangible assets. Okay, you'll see one of these two things out there. Goodwill, whenever you see goodwill on the books, goodwill is just an indication that a company has bought another asset or another company and has overpaid over book value for that asset. Okay, so let me give you an example. Let's say I have a car. I'm going to go back down. I'm going to go down here. Let's say I have a car and my car is worth $1,000. I find, so car, and the KBB, the Kelley Blue Book value, okay, says my car is only worth $1,000 because it's old. It's a Ford. Yeah, and you know I've driven a gazillion miles on it, and it's now down to $1,000 is what my car is worth. Now, if I sell this car to some sucker, okay, so I sold for. If I sold it to somebody for $1,500, even though the true value of the car was $1,000. On this sucker's balance sheet, right? So I'm going to say sucker. On their balance sheet, they're going to list property, plants, and equipment, right? Their car. They're going to list that for $1,000. And then they're going to list goodwill of $500 because they overpaid book value for my car. Okay? So you can think of this goodwill amounts as the price paid minus book value equals goodwill. And they call this goodwill because, you know, it's just like you're building goodwill with the person that you bought this from, right? Because you bought $1,000 worth of stuff for $1,500, so that extra $500 is, you know, goodwill. You being a good person, you being a nice person, right? So that's what we mean by goodwill. And it's intangible, right? Because the tangible part went into property, plants, and equipment. That was the car part, right? The part that I was willing to overpay just to be a nice guy type of thing, and I'm speaking as the sucker, just because I'm a nice guy, that extra $500 in value is intangible, okay? And there is a reason why we want to keep these things separate on the books, because, you know, we can really only sell what is completely tangible, or it's easier to sell what is completely tangible, okay? Now, other things in this bucket of other intangible assets that may not be something like goodwill. This other intangible asset, I'm going to draw a little line down to here. Other intangible assets, what you'll generally find here is that for restaurants, liquor licenses are intangible assets, right? Now, I'm not talking about the liquor that's sitting, you know, behind the bar and on the shelves that I'm ready to sell, or the wine cellar. It's the right to sell liquor in a certain region, right? Liquor licenses are considered an intangible asset because I can't touch that right to sell liquor, right? It's not like a chair or a car or a building, right? I'm buying a right. So a intangible asset that oftentimes has a lot of value on restaurant company books are liquor licenses. What you'll also find as an intangible asset is franchise rights. Franchise, or I'm going to call them area rights. So the perfect example would be to have like the franchise rights to be in and out, to open up in and outs in the San Francisco Bay Area. There is a certain value assigned to having that right, but it's not a tangible asset, right? But it is an asset, right? Because you have permission from in and out to be all in and outs inside the Bay Area. That's actually really, really valuable, but that's not tangible in any way. So you may have this other bucket of other intangible assets. Okay, so again, as a quick review, 2 ways to start thinking about how to categorize your assets on the balance sheet. You can categorize them in terms of liquidity, which you almost always see this on balance sheets. And then you can see how people will also break out tangible versus intangible assets. The intangible assets will generally have their own lines, and this is usually what you'll end up seeing. Okay. One last thing that I want to cover on terminology on the balance sheet is 2 terms. So we know kind of now how the balance sheet is laid out. It's laid out in terms of liquidity, and we know what it is, right? The balance sheet on the asset side is a listing of everything that you have. The last component that we're kind of missing is, so what are the numbers behind what we have, right? So we have like car worth $100, $1,000. Well, what does that $1,000 actually mean? That $1,000, the dollar amounts that are actually listed on the balance sheet is a reflection of the current value of the stuff the company holds or has to its name. Now, current value is super important because it's a reflection of how much of something is currently worth. It is not the same as how much you paid for that stuff. You have to remember, and this is key with the balance sheet, historical cost is not the cost that you necessarily see on the balance sheet. In particular, the values that you see on the balance sheet are going to be net amounts, right? So net, and I'm going to explain what net is, and it's going to be listed as either the lower of cost or market value as a rule. Okay. On the net side, what we mean by net is net of something that I've taken out. Okay, whenever you see the term net, it just signals to you that something else has been taken out of the equation. Something has been removed from that number. Okay, so in the case of property, plants, and equipment, hopefully I'll have some place to write this. You'll have property, plants, and equipment at cost, so how much they did pay for it, minus depreciation, minus impairment, right? And that will equal net property, plants, and equipment. Okay, so let's go back to my car, right? Let's say my car, and I'll just write this in as an example. Let's just say that my car, when I first bought it, bought, and let's say I paid $20,000 for my car. I drove it around a lot. It's now 10 years old, and if you've ever had to reimburse mileage that you've driven on your car, right, you're probably allowed like 10 cents per mile or something like that for wear and tear. So that's an example of depreciation on that car, right? So I'm just going to pull a number from thin air and minus depreciation, and I drove it for 10 years, and let's say that that's $7,000 worth of depreciation. Maybe I got into a car accident, right? And my car got dinged up a little bit. It still drives okay, but there are like these dents and scratches all over it. It doesn't look very good. It's impaired. The value of the car has now been impaired. So I'm going to impair $5,000, okay? And so that $20,000 car, I can't list my car for $20,000 on the asset side, right? Because I don't have $20,000 worth of car anymore because it's old, because it's dinged up. It's not what I have. Net of these items, net, right, of my car is now $8,000. This is the value of what I have. So even though I bought my car for $20,000, right, it's no longer worth $20,000. The net value of my car is now $8,000. Once you take into account that it's super old, it has a lot of mileage on it, and that I've like dinged up and scratched up my car, this is the net value of my car. Now, how much we depreciate and how much we impair that will leave up to the accountants that, graduate from, accounting programs and stuff like that, because they're the ones who, look up onto charts and tables to figure out what the appropriate amount of depreciation, amortization, and impairment might be, okay? Just realize that if you only have $8,000 worth of car currently, you are only allowed to put $8,000 worth of car on your balance sheet, not the amount that you had paid for it. Okay, so now let's extend the example a little bit in terms of our car. Okay, now this $8,000 I can list as my net value of the car. There's a second rule that you have to consider. There's the lower of cost or market rule. So my cost here was $20,000, but net the value is really only worth $8,000. Okay. Now, let's say that I am just like some super awesome famous person that everybody wants to own a little piece of Sybil, and everybody wants to, own the car that I've driven in. So even though I bought my car for $20,000, people are like, "Oh my God, Sybil drove that car and she's so awesome. I'm willing to pay $30,000 for that car," right? So let's say that the market, and I'm going to write it up here. Let's say that the market is willing to pay $30,000 because it is Sybil's car and Sybil is just that awesome. Market is willing to pay that. The original cost on it, right, was this, right? But the net value on my car is $8,000. I have to take this value on my balance sheet. I am not allowed to take market value because it's higher, and I have to take the lower of cost or market, and I have to take not something completely at cost, but I have to take into account the true value of that item now too, okay? So whatever is lower. So now let's say nobody likes me. Everybody hates me. So nobody wants my car simply because I have driven it. So if you remember back to there's a Seinfeld episode where Seinfeld has a valet take his BMW off to get parked. The valet brings it back, and the car smells. And the car smells just so horribly that Seinfeld can't stand it anymore. He abandons the car on the side of the street, right? So if that was my car, right, it's now worth less because Sybil sat in it and it has Sybil's cooties all over it, and it now really, really smells. So let's say that the market value on the car is now $5,000 because nobody likes me. I smell the car just, nobody likes the idea of owning a Sybil car, right? So even though it cost me $20,000, the market value is $5,000, the net value after depreciation and impairment is $8,000, I still have to take the lower of cost or market. So I still have to take this lower market value. This is the number that shows up on my balance sheet. Okay, so I have to take the lower of cost or market, and I can't just purely put the cost of my product on the asset side. I have to have the net value, net of depreciation and impairments. Okay, so we can depreciate, right? So show wear and tear, account for wear and tear. We can depreciate tangible assets. The parallel for intangible assets, because there's no wear and tear on something that you can't really touch, is called amortization. Amortization. So depreciation is to tangible assets as amortization is to intangible assets. And that's just a definitional thing that you have to know. Okay, so this is the balance sheet side of just kind of how to read the balance sheet, and we're going to go through a couple of examples in the next video.